Hi, everyone. Welcome to the Investment Solutions Mid-Year Review. I'm Stephanie Link, and here with my team, Lee Maker, Zach, Mike Shea, Robert Picard. We're going to just go through a couple of our thoughts for a few minutes each. If you have any questions, please feel free to do so, and we'll answer them as best we can. I'm going to start, and then I'm going to turn it over to Lee, and then to Mike, and then to Robert. So I thought I would just start by saying what a difference a quarter makes. Because when we did this call at the end of the first quarter, the markets were down 4.3%, but it felt a lot worse because we had so much in terms of unknowns, uncertainties. The second quarter, fast forward, we're actually up 10.9%, but the S&P 500 is up 27% from the April lows. So we've had quite a snapback as a result. So far, so good, at least in the recovery. And I think a lot of the reason that we have seen a recovery, I call it TGIF. So we're getting some of the unknowns a little bit more known. And TGIF stands for we're getting more information with regards to tariffs. We still have a long way to go, but we're getting a little bit more immune to the day-to-day news flow. In terms of geopolitical issues, the conflict seems to have died down for now around the world. It's still something that we worry about, but it's gotten certainly less frenetic. The I is inflation. We're certainly making progress on inflation. It's sticky at 2.7% headline, but we certainly are well below the peak seen 3 years ago at 9.1%. And the F is the Fed. Now, we still don't really know what the Fed is going to do, but with the labor market staying solid and with inflation coming down, and if we can get through the tariffs without a lot of inflationary pressures, which I believe to be the case, I think we're setting ourselves up for the fall of this year, sometime that the Fed does start to cut. We'll get more information and more details from Lee. So in the face of all of this noise, in the face of the unknowns and maybe the lesser unknowns, the economy is still hanging in. The economy is running at 2.5%. And it is mainly driven because of the consumer. And I have been talking about the consumer for years. I think all of us have, that the consumer has been resilient. And that has direct ties to the labor market remaining very strong. So you have non-farm payroll numbers, you have the job opening numbers, you have the weekly initial claims, which is the best reading on a real-time basis as to what is going on in the labor market. And you smooth that out over a 4-week period of time, you're running at 229,000 weekly initial claims. I've cited this other number a lot. During a recession, that number gets to 350 to 375. I would say in the spring, I was getting a little bit nervous that the weekly claims were jumping higher and higher each week. We got as high as 245, I believe. If you get to 260, that's the number I think I start to get, it's more of a reality that we are seeing a substantial slowdown. But we went from 245 back down to 221 this past week. So it's a very a fluid number, but it just kind of gives you a sense as the labor market remains firm. And wages remain above trend. And as I mentioned, inflation is coming down. So the consumer feels better and they are spending. We got retail sales numbers last week that were 3 times expectations. Consumer sentiment last week was the best in 5 months. And services, PMI services have been over 50, which is expansion, for the past year. And we root for services because that's 75% of consumption. We root for consumer because that's 70% of the economy. And then we've all talked about the renaissance happening in the manufacturing industry, and that's tied to AI. And if you believe in AI, that's tied to data center. And if you believe in data center growth, which I do, and we don't have enough of them, you need the grid, you need a better grid, and then you need power. And that is leading to activity in the manufacturing economy to be stronger than expected. And a lot of that has to do also with onshoring and doing all the data center build outs mainly here, or that's what the administration wants to convey and get to. So why do we care about the economy? I care about the economy because it directly impacts earnings. And those people that say it doesn't, I don't know what they're thinking. But in a 2.5% GDP world, you can grow mid-single digit revenues. And you can, if you get a little bit of margin expansion, you could see something like 10% growth for the year. That's what I believe we're going to see. Expectations are for 10%. And the interesting thing is it's very early on in the second quarter reporting season. Only 12% companies have reported, but 86% of the companies are beating so far, and they are seeing a 10.9% growth rate. And it's been led, believe it or not, by the banks. The banks put up a 20% on average earnings growth rate. Expectations were for 5.5%. Industrials, they are also doing quite well in terms of, yes, this onshoring, reshoring, AI build out, but also aviation is doing quite well. So you all know that I like to focus on themes. And I know I only have 3 minutes, so I'm going to rate them. Many of them have not changed. One is fairly new, but I'll say cybersecurity, I think it's bigger than AI. And it's because of AI, cybersecurity is going to be bigger. And we have 4,000 companies, both public and private, that I think you're going to see massive consolidation. The big are going to get bigger. I talked about AI and I talked about the data center. I like to play AI through the industrials, the manufacturing side of the equation. I mentioned aviation, animal health. We're going to spend $150 billion a year on animals between now and 2030. I happen to have 3 animals, and I think I've mentioned this many times. I spend more money on my animals than I do on my 18-year-old. Ride sharing is a new theme for me, and I can't believe I haven't mentioned this before. The AV part of the market is at 1.5 billion autonomous vehicles. 1.5 billion today. That is going to grow to 13 billion. There's enough room for autonomous vehicles for a lot of players. And then I would say, finally, last, because I do only have 1 more minute, is women's health. Women are going to come in to $40 trillion in the next 25 years. So it was not long ago that they were really involved in investing, and you're seeing the percentages of mainly the Gen Zs that are investing more, but the Gen Xs are as well, much more so than the baby boomers for women. In 1974, that was the first year that a woman could have her name on a credit card. How's that? That's crazy. 29% of women are in the C-suite versus 17% a decade ago. 39% of women in this country are MDs, managing directors. The point being is that women are getting more involved. 94% of women want a female advisor. We have 34% of women at Hightower that are female. Congratulations to all of you. The national average is 24%. You can invest in sports. The WNBA is the most popular sport industry out of all of sports. It's the most popular at the moment. And they're going to spend about $1 billion this year alone on that industry. You can own luxury homes because more women are buying more luxury homes. This is my favorite. They're buying more luxury jewelry. 31% of women last year bought themselves a diamond ring. How's that? And then finally, healthcare. This is a serious one. It's called Femtech. Femtech is technology designed just for women and their issues. Think of osteoporosis. But that's it for me. I'm going to turn it over to Lee.
Thanks, Stephanie. I got to ask you though, do you spend more on your pets? Are you including college tuition in there or not?
Well, I'm about to embark on that, that's for sure. But yes, I do. I spend a lot more on my pets.
Nice. Okay, cool. Thanks. Joking aside. So I'm just going to lead with a couple of opportunities we're seeing in fixed income right now. I'm going to start with long dated municipals. We sort of talked about this a couple of months ago. I think we're at a different part of the curve. We were mentioning more in the intermediate area, but right now there's a significant opportunity in, let's call it, just for illustrative purposes, 30-year munis. They have not been this cheap relative to treasuries in 3 years. So going back to 2022, the current ratio, the yield on a muni divided by a treasury, is 97%. So you're basically getting the tax exemption for free. And just to throw out a couple stats, we can make this real. A 10-year muni is at a 355. So if you're in the 40% tax bracket, that's a 591. Triple B corporates are at a 544. So you're going from a triple B corporate to a double A muni, and you're picking up 47 basis points. Now, where it gets really interesting is when you look at a 30-year. A 30-year muni is at a 508. And so a taxable equivalent yield is an 847. And triple B corporates generically are at 612. So that's 235 basis points, and you're getting an upgrade in credit quality. Now, the question you might want to ask is is there some reason for this, or is there something we're missing? Is there like a wall of maturities looming in the municipal space? And yeah, the COVID money, you could argue, has run out, so there's less stability, but overall the picture is really just supply dynamics, right? They have run out of some of the COVID stimulus money, and now they're starting to enter the market again. And as often happens when there are not, I wouldn't call this a shock to the system, but there's a lot of supply coming into the market, and given the uncertainty, a lot of the issuance has been on the longer side. And as investors and ETFs and mutual funds sort of digest this, there is a significant opportunity, right? So supply dynamics are really the story here, but that is an unmistakable yield advantage at roughly 240 basis points and an increase in credit quality. So that sort of dovetails into the second opportunity, which is one we've been sort of hammering on all year, and that's just upgrading your portfolios in credit quality. Now, we're not saying you need to go from like a single B high yield portfolio to a triple A, but wherever you're comfortable on the curve, credit is on sale, right? It's at or near all-time historic lows. And this is not like the stock market where, it can keep going higher forever. At some point, spreads can't go through treasuries. So the difference between a single B and a double B is as cheap as it's ever been. Conversely, you can go from a triple B to a single A. I would say in the high yield market, so we do a high yield light portfolio. I'm not saying that you need to get rid of high yield exposure. Again, it's individual risk parameters to be advised, but the high yield space is turning much more of a name specific area for us. So something where we can see leverage ratios decreasing or top line revenues increasing. So it's not like I don't want to paint it with a generic brush, but take what the market is giving you, and right now it's giving you credit quality on sale. Looking back, just since this is a recap call, I'll spend 10 seconds talking about what happened in 2025 before we pivot to what we see for the next 6 months of the year. Obviously, there was significant interest rate volatility, right? A lot of that occurred in April. But surprisingly, or maybe not surprisingly, there was moderately positive performance from all the indices, right? The one exception was high yield munis, and I think given the duration, how long those are, that was a little bit of a play in there. But yields are overall lower this year. And if we're looking at credit versus munis have been underperforming credit. So going forward, I think it's going to be a little bit more of the same, right? As Stephanie mentioned, tariffs and it is slowly waning in terms of market impact. But obviously not gone. So I think the volatility is going to continue a little bit. We still have tariffs. We still have to resolve them. I don't know if these are considered trade wars or not, but we need to figure that out. And then obviously we're still waiting to see how that affects inflation, because obviously that could be built into the price of bonds. The Fed guessing game is definitely going to continue. The probability of rate cuts is falling again. I feel like we're kind of reliving 2024 again. 3 weeks ago, September was at 100%. Now it's down to 60%. I'm not advising that anybody use the Fed prediction market as an investment thesis, but still something to pay attention to, because that's how the market is going to price some of the longer debt, and especially the yields on the short end. All these factors are weighing in, obviously, as we sort of figure out what Powell and the Fed wants to do. Data dependency is out there. And then obviously labor market, strength, weakness, whichever side you're on, and the inflationary effects of tariffs. The one thing I will note that it's gotten a little more resolved, but we would like to see it some more stability to it is the fact that the Fed independence came into question last week. I mean, the fact that this is a bullet point in this webinar is bad. There's just no way around it, right? Concerns have calmed down significantly since both Bessent and Trump's comments last week, but it's still a big deal to the markets, right? I mean, we got a sneak peek at what it would look like if something like that did happen, and obviously it's not great. 2-year yields went down, which makes sense because the Fed controls the front end of the curve. The 10-year went up. I think there's some assumptions that, if this were to happen, whoever would come in would be obviously much more closely aligned with Trump, and his indications has been that he wants yields to be, significantly ratcheted down. Inflation expectations picked up for a short term, equity sold off, and probably most importantly, the dollar sold off, somewhat stymieing the recent rally we saw off the lows. So, I don't know where this ends, but, obviously I hope that cooler heads prevail, because, however independent or non-independent you think the Fed is, you just don't want to approach a situation where it's sort of politically captured and obviously, moving the interest rate based on the whims of where elections go. And I don't think we're there, but it was good to get a little preview, and hopefully that sort of guides cooler heads to the end. Some other headwinds, obviously tariffs, not to state the obvious, but if we do get inflation, and it seems like some of the data is that consumers might end up paying a little bit of it. I mean, we're getting a little long in the tooth here, so we'll see if that actually comes through. Outlook for rates. I think it's important that we just took out 5% in the 30-year last week. And that's sort of a critical level that we talk about. It was nice to see sort of buyers come in and lower that yield. Obviously, there's a lot of noise going on right now, and it's hard to isolate that as the cause. But I think pricing in fixed income markets and the risk of a big event, I think this is an appropriate level for rates for the rest of the year. But that's a huge asterisk to say that there won't be any significant effects. On the front end of the curve, I think the Fed has made it clear that they want to cut. I just would caveat that by saying eventually they want to cut. Obviously, the administration wants to cut, so that would lead me to think that we will see a steeper yield curve. Hopefully, that occurs from the front end going down and not a bear steepener from the long end going up. But overall, there's yield to be had. Credit conditions, corporate balance sheets are all healthy. That's a good thing. I mean, it means fixed income can positively contribute to asset allocation and obviously make a meaningful difference in people's portfolios.
Thanks, Lee. Mike, turning it over to you.
Thank you, Steph. It's been quite a 2 years packed into 6 months. In a normal year, I think there are typically 1 or 2 fat pitches that you get to take action on, and we've seen a couple already this year. If you think back to January, as soon as the year turned, you learned a little bit about the dangers of adjusting your investments based on narratives. And all we heard about starting in January through well into April was how bad politics were, how terrible the tariffs were, the dangers of trade wars, et cetera, et cetera. And the consensus view among strategists and other investors and people that you saw in the media every day was we really need clarity. My view at the end of Q1 was that clarity comes at a great cost. By the time things are clear, it's priced in, and typically at different levels than what you were hoping for. And that turned out to be the case again. The V bottom that happened on April 7th or 8th was impressive, to say the very least, and took off at a velocity you rarely see. That was really a great pitch to swing at. And if you were involved and had your wits about you, you've really done very, very well. Well, here we are after the big rebound, and the S&P is up, Steph, correct me if I'm wrong, 7.3, 7.4%, something like that for the year.
Up 27 for since the bottom.
27 since the bottom. Very impressive move. But year to date, 7.5 is a little better than historically what you would expect over the course of human history out of the equity market. It's pretty good. Valuations are a little elevated. They're not a bargain any longer. They were in April, but they're no longer extraordinary. So in my opinion, we don't have any big calls to make right now. It's kind of a steady state market. It's got its challenges. It always does. There are certain opportunities. There always are. But it's not a time to really have a hero complex about anything. You just kind of buckle down and do your analysis, and you pick and choose among the opportunities. So I'll talk about a couple of things that I think are a little bit interesting that may be slightly different than what we've seen in a while. We have, out of kind of nowhere, seen a little bit of improvement in China. We went a pretty long time waiting for the expected China reopening trade. I think I had like 4 birthdays that went by while we were waiting for that to happen. And and it didn't. And now it's really not even on the tip of anybody's tongue any longer. And out of nowhere, we saw a couple of things that were a little better. The gaming revenues in Macau, for instance, started to improve, which was kind of a surprise. And then we saw a little bit of improvement in luxury goods sales globally, really, but also participating in China. That was a nice surprise. It's been a while coming. those create opportunities for us in individual names. We saw airlines start to show better bookings results, saying that after a little bit of a hiatus, we started to see bookings improve. I think that bodes well for what we see through the travel season of the rest of summer and into the fall. That's a good indicator. What's lagging? Housing still sleeping a little bit. I think that will improve, but it's been 2 years off. Most markets around the country are seeing plenty of supply. Anybody who lives in Florida can talk about that. There's a lot of supply on the market. And it's been slow to see that steady up a bit and come back into equilibrium. I think it will because, Steph, as you said, the consumer's in good shape, the jobs numbers are great, average hourly earnings are great. All of the ingredients are there for demand to start to show itself again. And I think that will be a little bit of a sleeper play in the housing sector for the second half of the year. I think the banks are a mixed bag. The banks are an area where you can make a value choice and leave the others for other people to get involved in. In technology, the V bottom was something really to be seen. The fastest growers took off like rocket ships, and it left some things behind that I think people are sleeping on a little bit. And then my sleeper play is, once again, which means I've been dragging this around for a while, is energy. These are very, very cheap stocks, single-digit multiples, yields of 3.5% to 4.5%. If we're seeing a little bit of economic improvement globally, which seems to be the case, it's unavoidable that we will use more energy products, and I think the earnings and cash flows will continue to improve at those companies, and the stocks are just sitting there waiting. And I'll stop there.
Thanks, Mike. I like your housing call a lot. I like all your all your calls. Now on to Robert for private markets.
So closing with private markets, and let me tell you, all three, it's really hard to follow the three of you. And I'll try to keep this going with the same tempo and as much data. First of all, we are a complement to everything that Stephanie, Lee, and Mike do on the public market side. We're here to provide you with solutions and the ability to really plant seeds to complement, develop, and enhance your portfolio with all those opportunities that are typically not necessarily available in the public markets. And just as and a frame, and I've given this statistic often, for all those companies that generate more than $100 million in revenue, 91% of those companies are still privately owned. And we're seeing now more and more people embracing private markets, the democratization of private markets. There's more and more products that are becoming available that make it much easier, whether it be tender offer vehicles for accredited investors, whether it be interval funds for accredited investors. I want to address a few points that I think are important that we've seen some concerns over the past several months, one of which is brought up by Mike Shea and several other teams, which is the perceived, there were a number of articles that appeared about credit. And is private credit to a certain degree a bubble in the markets? And our general view has been that we do remain concerned that certain areas and pockets, depending on what happens in the economy, that there is, we want to make sure we're investing with the best managers, the managers who are well allocated and invest in the best opportunities. But I think what really, from a framework perspective, there's this ongoing crossover between private and public. And what we're seeing now is both commercial banks and, to a certain degree, community banks that have historically been extending loans and providing loans to consumers and to businesses are basically slowly being reduced in their exposure. And that's really being taken over by the private credit players. And those private credit players are generally extremely sophisticated, very savvy, really very diligent in how they allocate. And we really actually believe that there's a great opportunity to generate higher returns with some of the leading money managers, provide you diligence and research, and can add them to your portfolio. We actually think that private credit is still an excellent solution, and we think that the market capitalization of the overall private markets in general is going to grow to $30 trillion plus over the next 10 years. And private credit alone is probably going to account for 10 trillion of that. And a lot of that could be related to some of the new areas that we're looking at, including royalties, whether it be media royalties, healthcare royalties, whether it be publishing royalties and others, that's definitely of interest on a go-forward basis. On the private equity side, we recognize that there's been a bit of a slowdown, both with exits and in view of kind of what's been happening in the economy. That said, huge opportunity in the secondaries private equity market. We have a number of solutions for your clients and our practices in that space. And also we continue exactly complementing everything that Stephanie, Mike, and Mike are working on, which is certain key themes. Cybersecurity, our first vintage was back in 2023. We had one of our larger exits from that, which was Protect AI, which was taken out by one of Stephanie's portfolio companies. And that was, I think, a perfect illustration of the complementary and the crossover between public and private. And that's really benefited the cybersecurity vehicle. We're going to be coming back to market later in the year or early 2026 with the next vintage of that vehicle. We're also continuing to look at other growth opportunities. We're going to be coming to market with a few other solutions, both in technology, AI. We're also looking at the healthcare and food arena, which is coming to market. And that actually works perfectly into one of your themes, Stephanie. And then moving on to continuing with the whole theme of artificial intelligence, including data centers on the real estate side, and the opportunities for single family rentals, which continue to be one of the areas of focus that we're looking to continue to develop. Lastly, our investment committee that's comprised of both Stephanie and a number of our leading advisor practices have been very active. We ourselves on the investment solutions side have brought to market several ideas for asset allocation and how to allocate or add private markets to your portfolio. We've really come to a concept of a conservative, balanced, and aggressive asset allocation for private markets. So we're going to share more of that over the coming weeks and months, which has been developed. We're also looking at the opportunity to do vintage funds, which may make it a lot easier for you to get exposure either via model portfolios and other solutions on the asset allocation side, and continue to enhance your overall exposure to private markets. And that's it. A lot of exciting things to come, and look forward to discussing further over the coming days, weeks, and months.
Well, thank you, Robert, Michael, Lee. We're out of time, actually. So I think that these calls are so important because I learned something new every one of them. And so I think there are a lot of great ideas. And well, we've got a couple of months ahead of us that are going to be certainly interesting. It's never a dull moment, right? In fixed income, in equities, and in private markets. We're here to help all of you, and we're happy to help all of you. If anyone has any questions that we couldn't get to because we ran out of time, please feel free to email any of us. We will absolutely answer, and we'll do this again. See you in January.